Introduction. Hello, everyone, and welcome back to Financial Mo. Today, we have a fascinating topic on the agenda that has intrigued many, but often seems like a complex puzzle: the stock market. Don't worry. We're going to break it down into bite-sized pieces so that even if you're a complete beginner, you'll walk away with a clearer understanding. Before we dive in, make sure to hit that subscribe button and ring the notification bell so you never miss out on our insightful content. Alright, let's get started. What is the stock market? To kick things off, let's address the fundamental question: what is the stock market? Simply put, it's a place where you can buy and sell shares of publicly traded companies. Imagine it as a giant marketplace where investors come together to trade ownership in various businesses. Example: Apple Inc. Take Apple Inc., for instance. When you buy a share of Apple, you're essentially purchasing a tiny piece of the company. As Apple grows and becomes more profitable, the value of your share increases. How does the stock market work? Now, let's talk about how the stock market works. At its core, it's all about supply and demand. Explanation: supply and demand. When more people want to buy a stock than sell it, the demand goes up, and so does the stock price. Conversely, if more people are selling than buying, the price drops. Example: initial public offering, IPO. When a company goes public through an initial public offering or IPO, it issues shares to the public for the first time. Investors can then buy and sell these shares on the stock market. Types of stocks. Not all stocks are created equal. There are different types, each with its own characteristics. Explanation: common versus preferred stocks. Common stocks give you voting rights in company decisions, while preferred stocks come with priority in receiving dividends. It's like choosing between voting power and a guaranteed share of profits. Example: dividends. Dividends are a portion of a company's profits paid out to shareholders. Some companies pay dividends regularly, making them attractive to income-focused investors. Market indices. One common term you'll encounter is market indices. Let's demystify that. Explanation: market indices. Market indices, like the S&P 500, represent a basket of stocks from different companies. They serve as benchmarks to gauge the overall performance of the stock market. Example: S&P 500. The S&P 500, for instance, includes 500 of the largest publicly traded companies in the US. When people say, "the market is up," they often refer to the performance of indices like the S&P 500. Risks and strategies. Now that we've covered the basics, let's talk about risks and strategies. Explanation: risks. Investing in the stock market involves risks. Prices can be volatile, and there are no guarantees. It's crucial to only invest money you can afford to lose. Strategy. Diversification. One common strategy to manage risk is diversification. By spreading your investments across different sectors and industries, you reduce the impact of a poor-performing stock on your overall portfolio. Factors to consider before investing in Canada. Factor 1. Financial goals in Canada. Define your financial goals in the Canadian context. Are you investing for short-term gains, like a down payment on a house, or for long-term objectives, such as a comfortable retirement within the Canadian system? Factor 2. Researching Canadian companies. Conduct thorough research on Canadian companies. Examine their financial health, growth potential, and relevance to the Canadian market. Fundamental analysis is equally crucial here. Advantages and disadvantages of investing in the Canadian stock market. Let's now explore the pros and cons of investing in the Canadian stock market. Advantage 1. Stability of the Canadian market. One significant advantage is the stability of the Canadian market. Historically, it has shown resilience even during global economic downturns. Advantage 2. Dividend-paying Canadian stocks. Canada is home to many dividend-paying stocks. This means you can potentially earn a steady income through dividends, making these stocks appealing to income-focused investors. Disadvantage 1. Concentration in certain sectors. On the flip side, the Canadian market can be concentrated in specific sectors, like finance and energy. Overexposure to these sectors may expose your portfolio to sector-specific risks. Disadvantage 2. Limited market size. The Canadian market is smaller compared to global markets. This limited size may impact the variety of investment opportunities available. Platforms for investing in the Canadian stock market. Moving on, let's explore the platforms Canadians can use to invest in the stock market. Platform 1. Canadian online brokerages. Canadian online brokerages such as Questrade, Wealthsimple Trade, or TD Direct Investing allow you to easily trade Canadian stocks. They offer user-friendly interfaces and access to the Canadian market. Platform 2. Canadian robo-advisors. Canadian robo-advisors like Wealthsimple Invest use algorithms to manage your investments. They are suitable for those who prefer a hands-off approach and want their portfolios managed automatically. Platform 3. Traditional Canadian brokers. Traditional Canadian brokerage firms like RBC Direct Investing or Scotia iTrade offer a range of investment options and personalized advice for those who want a more hands-on approach. Additional tips and information. Before we conclude, let's cover some additional tips and information to help you navigate the Canadian stock market. Tips. Tax-efficient investing in Canada. Consider tax-efficient investing strategies in Canada. Take advantage of tax-advantaged accounts like the Tax-Free Savings Account, TFSA, and Registered Retirement Savings Plan, RRSP. Dollar cost averaging. Implement dollar cost averaging. By consistently investing a fixed amount at regular intervals, you can reduce the impact of market volatility. Conclusion. Well, there you have it, a beginner's guide to the stock market. Remember, investing is a journey, not a sprint. Take your time, do your research, and consider consulting a financial advisor. If you found this video helpful, give it a thumbs up and share it with your friends. Don't forget to subscribe for more educational content. Until next time, happy investing.